Bitcoin first. Why investors need to consider Bitcoin separately from other digital assets. Chris Kuiper, CFA, Director of Research, Jack Neuruder, Research Analyst, January 2022, Fidelity Investments, Fidelity Digital Assets. Executive Summary. Once investors have decided to invest in digital assets, the next question becomes which one? Of course, Bitcoin is the most recognized, first ever digital asset, but there are hundreds and even thousands of other digital assets in the ecosystem. One of the first concerns investors have regarding Bitcoin is as the first digital asset, it may be vulnerable to innovative destruction from competitors, such as the story of MyFace and Facebook. Another common consideration surrounding Bitcoin is whether it offers the same potential reward or upside as some of the newer and smaller digital assets that have emerged. In this paper, we propose Bitcoin is best understood as a monetary good, and one of the primary investment theses for Bitcoin is as the store of value asset in an increasingly digital world. Bitcoin is fundamentally different from any other digital asset. No other digital asset is likely to improve upon Bitcoin as a monetary good because Bitcoin is the most, relative to other digital assets, secure, decentralized, sound digital money, and any improvement will necessarily face trade-offs. There is not necessarily mutual exclusivity between the success of the Bitcoin network and all other digital asset networks. Rather, the rest of the digital asset ecosystem can fulfill different needs or solve other problems that Bitcoin simply does not. Other non-Bitcoin projects should be evaluated from a different perspective than Bitcoin, and Bitcoin should be considered an entry point for traditional allocators looking to gain exposure to digital assets. Investors should hold two distinctly separate frameworks for considering investment in this digital asset ecosystem. The first framework examines the inclusion of Bitcoin as an emerging monetary good, and the second considers the addition of other digital assets that exhibit venture capital-like properties. What is Bitcoin? It is beyond the scope of this paper to provide a detailed explanation of Bitcoin. However, we do think it is important to emphasize some of the basics that are necessary to understand how Bitcoin has maintained a competitive advantage in the quest to present the de facto non-sovereign monetary good of the digital asset ecosystem. Bitcoin the network versus Bitcoin the asset. One of the most confusing concepts for those who are new to Bitcoin is understanding that the word Bitcoin can refer to two related but distinctly different things. There is Bitcoin the network or payment system, and then there is Bitcoin the token or asset. To help avoid confusion, we will adopt the standard of capitalizing Bitcoin when referring to the network and using a lowercase character for Bitcoin, the token or asset. Bitcoin was first just an idea that set out to solve the problem of creating a truly peer-to-peer electronic cash system. Although we can transact in the physical world without an intermediary using cash, until Bitcoin was invented, this was not possible in the digital realm. This idea was put into practice by writing code. Therefore, Bitcoin is just code. And Bitcoin the network is made up of millions of computers all running the identical Bitcoin software. This code acts like a protocol and provides the rules that govern the Bitcoin network. This network operates a payment system where users can send and receive a digital token, also called Bitcoin. The Bitcoin network is not compatible with other networks. Anyone can join or leave the Bitcoin network as long as they follow the core rules. Anyone that tries to change the rules without the consensus of enough of the other participants will be excluded from the network. Therefore, while Bitcoin's code is open source and can be copied and modified, these copies or derivations of Bitcoin are entirely separate networks and are not backward compatible with the original Bitcoin network. Furthermore, Bitcoin tokens are native to the Bitcoin network and cannot be removed or transported to another blockchain network. The importance of this will be revealed later in the paper as we discuss the power of network effects and why we see one network dominating the market. Why we believe Bitcoin is best understood as a monetary good. What is money? We believe money is a tool that allows exchange rather than barter. Throughout most of history, we have seen humans iterate in search of the best representation of money. A monetary good is a good that is valued for its tradability for other goods, not its consumption or use. Throughout history, various goods have been used as money, such as shells, beads, stones, fur, and wampum. Which leads to the question, why do some things become treated as monetary good while others do not? Economists and historians suggest the answer lies in a number of characteristics that make good money. The characteristics a good possesses, the more characteristics a good possesses, the better it can serve as being money, or the more likely it will emerge or be accepted as money. Again, there's a chart of gold, Bitcoin, in fiat currency and all the monetary properties that sound money obtains. And you can see that chart here. Bitcoin clearly possesses a lot of good qualities of money, combining the scarcity and durability of gold with the ease of use, storage, and transportability of fiat, even improving on it. It is also worth noting that just like other monetary goods, Bitcoin is not a company. It doesn't pay a dividend or have cash flows. Therefore, its value must be derived from its ability to better fulfill the characteristics of a monetary good compared to traditional alternatives. Bitcoin's value is driven by its Bitcoin's value is driven by its enforceable scarcity. One of the greatest characteristics of Bitcoin's properties is its scarcity. Not only is Bitcoin scarce, Bitcoin's current inflation rate of 1.8% is roughly equal to gold inflation rate at the moment, but unlike gold, it is also provably finite. There will only ever be 21 million Bitcoin. No other digital asset possesses an immutable monetary policy on the level of Bitcoin. In other words, Bitcoin's monetary policy may be viewed as the most credible. But how is Bitcoin's scarcity, its 21 million supply cap, enforced? Two key characteristics underpin this credibility and are necessary to understand Bitcoin's enforced supply cap, as well as why it is distinct from every other digital asset. The first is Bitcoin's decentralization. No one person, corporation, or government owns or controls the Bitcoin network or the rules that govern the network. As a completely decentralized network that is running open source code, the participants in the network must adhere to the code's rules that govern the network. The 21 million supply cap was written in the original Bitcoin source code, which continues to run the Bitcoin network today. But if the network is operated by mere code, can't this code be changed? Yes, but only through consensus of the network participants, the node operators. A change in Bitcoin's supply schedule is something that could happen in theory, but almost never will in actual practice. First, gaining consensus is enormously hard to do because Bitcoin's network and market participants are so widely dispersed. There is not a large consortium to have sway or voting power. More importantly, the network was designed with incentives to not change the supply cap. It would not be in the economic interest or the current network participants it would not be in the economic interest of the current network participants to raise or adjust the supply cap, as doing so would only serve to inflate the supply of Bitcoin and dilute the value of their holdings, or in the case of miners, their mining rewards. Here we see the powerful effects of game theory at work, as it is in the best interest of all participants to coordinate, cooperate, and not change the supply cap. Second, the Bitcoin network is censorship resistant. Because no person, corporation, or government owns or controls the Bitcoin network, it is very resistant to censorship. In addition, the Bitcoin network has no geographical boundaries, making it difficult for a nation-state to assume control or regulation of the network and the core Bitcoin code itself. To review the step-by-step logic as to why we believe Bitcoin is a monetary good that has value. Number one, a monetary good is something that has value attributed to it above and beyond its utility or consumption value. Although Bitcoin's payment network certainly has utility value, people are also ascribing a monetary premium value to the Bitcoin tokens. Two, one of the primary reasons investors attribute value to Bitcoin is its scarcity. Its fixed supply is the reason it has the ability to be a store of value. Number three, Bitcoin's scarcity is underpinned by its decentralization and censorship-resistant characteristics. Number four, these characteristics are hard-coded into Bitcoin and almost certainly will never be changed because the same people that ascribe value to Bitcoin and own it have no incentive to do so. In fact, the network participants are incentivized to defend these very characteristics of a scarce asset and an immutable ledger. Why we believe Bitcoin has the potential to be the primary monetary good. Investors may agree that Bitcoin possesses many of the qualities that make for good money, but who is to say that only one monetary good can or will exist? We won't be so bold as to predict there will be only ever one money, but we do believe that one monetary good will come to dominate the digital asset ecosystem due to the very powerful effect of networks. Monetary network effects are extremely powerful. Many investors are familiar with the power of network effects, where the value of a given network increases exponentially as the number of its users grows. Monetary networks are no different. However, they are even more powerful than the other networks because the incentive to choose the right money is much stronger than any choice of a network such as a social network, telephone network, etc. If investors are looking for a digital asset as a monetary good, one with the ability to act as a store of value, then they will naturally choose one with the largest, most secure, most decentralized, and most liquid network. Bitcoin, as the first truly scarce digital asset ever invented, received a first mover advantage and has maintained this advantage over time. Note that while Bitcoin's dominance, or its market capitalization as a percentage of the entire digital asset ecosystem, has declined from 100% to approximately 50%, that is not due to it shrinking in size, but rather the rest of the ecosystem growing. And again, there's a chart here with the Bitcoin dominance you can see on the video. There's also a reflexive property to monetary networks. People observe others joining a monetary network, which incentivizes them to join as well, as they also want to be on the network where their peers or business partners reside. This can be observed on a smaller scale with payment networks today, as platforms like PayPal and Venmo have grown at an accelerating rate. In the case of Bitcoin, the reflexive property is even more pronounced because it doesn't just include passive holders of the asset, but it also includes miners that actively increase the security of the network. As more people believe Bitcoin has superior monetary properties and opt to store their wealth in it, demand increases. This in turn leads to higher prices, particularly as supply is inelastic or unresponsive to price. Miners are then incentivized to increase their capital expenditure and computing power, as higher prices lead to higher profit margins. More computing power devoted to Bitcoin mining leads to higher security of the network, which in turn makes the asset more attractive, leading once again to more users and investors. This network competition is likely to result in a winner-take-all scenario as the network grows and becomes more valuable, because the choice of any other monetary network that does not become the dominant one will result in a loss of investment. Every investor looking to store value in a monetary good is making a choice as to which monetary network they are opting into, whether they are acknowledging it or not. And again, there's the picture of the loop of the virtuous cycle or the reflexivity of Bitcoin here to the side in the video. More users and holders create more higher demand, higher prices, which attract more miners, which give it more security, which then makes it more attractive, and the circle continues. Any subsequent monetary good would be reinventing the wheel. The phrase, "don't reinvent the wheel," is so common it has become a cliche. Nevertheless, we think this applies to Bitcoin as a digital monetary good. The invention of the wheel represented an entirely new technology that, once invented, can never be reinvented. Similarly, never before in human history had the problem of digital scarcity and a true peer-to-peer electronic cash been solved until Bitcoin was invented. Solving this problem was not merely an incremental improvement, but a leap forward or an unlocking of the puzzle of how digital scarcity could exist. Because Bitcoin is currently the most decentralized and secure monetary network relative to all other digital assets, a newer blockchain network and digital asset that tries to improve upon Bitcoin as a monetary good will necessarily have to differentiate itself by sacrificing one or both of these properties, an idea we explore in more detail below, the blockchain trilemma. A competitor that tries to merely copy Bitcoin's entire code will also fail, as there will be no reason to switch from the largest monetary network to one that is completely identical but a fraction of the size. The Lindy effect and Bitcoin's anti-fragile qualities. The Lindy effect, also known as Lindy's law, is a theory that the longer some non-perishable thing survives, the more likely it is to survive in the future. For example, a Broadway play that has run for 10 years is likely to run another 10 years compared to one that has run for only 1 year. We believe the same may apply to Bitcoin. Every minute, hour, day, and year that Bitcoin survives increases its chances of continuing into the future, as it garners more trust and survives more shocks. It is also worth noting that this goes hand in hand with the property of anti-fragility, where something becomes more robust or stronger with each attack or time the system is under some form of stress. In fact, if an investor were presented with the idea of Bitcoin and then asked to come up with a list of stressors, attacks, shocks, or failures that would likely be the demise of this nascent technology, they would probably underestimate all the negative events that Bitcoin has already endured that have not proven to be the death knell of the network. A non-exhaustive list of some of the negative effects that Bitcoin has already endured. 1. Created by an anonymous person or persons whose true motive or any affiliation is unknown. Number 2. Used in the dark web for illicit purposes. Number 3. Has been labeled a fraud, Ponzi scheme, and speculative gamble. Number 4. Some Bitcoin tokens have been confiscated by the FBI. Number 5. Endured a civil war regarding the core code. See block size war section. Number 6. Remains primary form of payment for ransomware attacks. Number 7. Multiple exchange hacks. Number 8. Prices suffered multiple 50% plus drawdowns, many larger than 80%. Number 9. Has endured multiple forks in its code. Number 10. Has been declared dead hundreds of times by major news outlets and famous investors and CEOs, etc. Number 11, banned in multiple countries. Number 12, copied by competitors thousands of times. Why another digital asset is unlikely to supersede Bitcoin as a monetary good. Perhaps investors agree that Bitcoin is currently the best monetary good in the digital asset marketplace, and that it is likely that one digital monetary good will dominate the market due to network effects. However, couldn't a superior or more improved version of Bitcoin be created and become the dominant monetary good? Isn't Bitcoin's code open source so that anyone can copy it and improve upon it? While it certainly is possible in a free market of emerging digital assets, we believe it is highly unlikely for Bitcoin to be replaced by an improved digital asset for several reasons. One of the biggest reasons is that any improvement in one characteristic of Bitcoin, such as improving its speed or scalability, leads to a reduction in another characteristic, such as Bitcoin's level of decentralization or security. This trade-off is known as the blockchain trilemma. The blockchain trilemma. As far back as the early 1980s, computer scientists identified a kind of trilemma embedded in decentralized databases. More importantly, a variation to this trilemma, known as the blockchain trilemma, was outlined by Ethereum creator Vitalik Buterin, where he states that a decentralized database, of which Bitcoin is one type, can only deliver on two of three guarantees at one time: decentralization, security, or scalability. Security. Security refers to how likely it is the network can be attacked or compromised. In the case of a decentralized network like Bitcoin, the main concern is a 51% attack, whereby a single person or entity controls more than half the Bitcoin's computing power, network's computing power, known as hash rate. If this is achieved, the attacker could control the network, or more specifically, make changes to the open ledger, such as performing double spending or reversing transactions. Trust in the network would be lost and could collapse the entire network. As the Bitcoin network becomes larger, with more nodes and miners distributed among more people, entities, and geographic areas, it becomes harder and more expensive to attack. And here's a graph of the mean hash rate on the side of the video here. Bitcoin is by far the most secure digital asset when measured by the hash rate or computing power that is securing the network compared to other digital assets that use the same hashing algorithm as seen in that following graph. Unfortunately, because of the differences in hashing algorithms, Bitcoin's hash rate cannot be directly compared to the hash rate of other digital assets, most notably the second largest digital asset by market capitalization. However, we can compare total annual energy usage as a proxy for security, with more energy uses as a measure of more mining resources dedicated to securing the network. On this measure, Bitcoin is estimated to consume approximately 137 terawatt hours annualized, compared to approximately 25 terawatt hours for Ethereum. Decentralization. Decentralization refers to how much control any one person, entity, or group may have on a system or a network. In a decentralized network, consensus is achieved through a kind of voting mechanism. In this system, no single entity can control or restrict the data. In an open decentralized network, anyone is also free to join, and no entity can exclude them as long as they follow the rules or the protocol of the network. This allows the network to operate without intermediaries. The cost of higher decentralization is lower throughput of the network, or the speed at which information can pass due to the need for a larger consensus. The opposite of a decentralized network would be a completely centralized network where one intermediary controls all aspects of the network. The advantage to this is incredible speed and throughput, as there does not need to be a consensus, but the disadvantage is the need to then trust this single intermediary. Bitcoin is the most decentralized asset based on many factors. For example, as a recent Coinmetric report noted, Bitcoin continues to show increasing decentralization as the number of holders has become distributed. Active addresses continue to increase, and Bitcoin mining pools continue to become more fragmented and competitive. Furthermore, Bitcoin's computing power, known as hash rate, has recently undergone a great distribution. Only a few years ago, it was estimated that approximately 75% of Bitcoin network's hash rate was coming from operators located in China and only 4% from the United States. Most recently, due to China's ban on these activities, virtually none is located in China, and now the US holds the top spot at approximately 35%. Scalability. Scalability refers to how well the network can handle growth, such as the growth in the number of users and how many transactions the network can handle in a limited amount of time. Scalability has notably been the Achilles heel of the Bitcoin network as it maximizes decentralization and security, but as a result is the network with one of the slowest transaction throughputs. The Bitcoin network adds a new block and validates transactions on average only every 10 minutes. And because Bitcoin's block size is limited, only so many transactions can fit into each block. To put this into perspective, the Bitcoin network is able to process approximately 3 to 7 transactions per second, versus a highly centralized payment network like Visa, which processes approximately 1,700 transactions per second with the ability to scale and process multiple times if needed. None of the characteristics above are in and of themselves better than another. It depends on the use case. Some users may favor scalability over decentralization or vice versa. Our only point here is to understand there is an inherent trade-off. To summarize, we believe Bitcoin is currently the most secure and decentralized monetary network. Therefore, this excludes other networks that are competing on different use cases besides money. We also believe the Bitcoin network will continue to be the most secure and decentralized in the future due to the blockchain trilemma as outlined above, and also exemplified in a real-world example below, the block size war. We also believe because monetary networks have massive network effects, Bitcoin's security and decentralization will only grow stronger over time. Could another network come along in the future that somehow improves upon Bitcoin as a monetary network? We concede there is a non-zero chance, but believe it is incredibly small due to our arguments outlined here. And again, there's a blockchain trilemma graph, a chart here to the side, a picture. A real-world example of trying to improve Bitcoin, the block size war. As we previously noted, Bitcoin's transaction throughput is limited by both the time when each block is added and transactions are validated, approximately every 10 minutes, as well as the block size, a little over 1 megabyte, which limits the number of transactions that can fit into each block. Some users and developers therefore propose a seemingly simple and straightforward way to address this problem: increase the block size to greater than 1 megabyte. While this may seem to represent a non-controversial and simple change, it actually spawned a fierce war within the developer community that spanned years. The debate can be summarized by putting the opposing views in two camps: the small blockers versus the big blockers. While the block size was the specific piece of code at the center of the debate, the issue at stake was actually a larger one regarding the principles of what Bitcoin is and how it should or shouldn't evolve. Those that wanted the original block size or smaller blocks generally favored robust protocol rules that would be very hard to change with a long-term focus on Bitcoin stability. This ethos continues today with many proposed code changes, even upgrades that are considered improvements, failing to get implemented. In the small blockers' view, any change in the code could potentially open up the Bitcoin network to a new or unforeseen attack vector. The small blockers also believed the ability for individuals or average users to run a personal node was important to preserving Bitcoin's security and decentralization. Bigger blocks would mean more history to archive in the blockchain, and therefore making running a node, Bitcoin's ledger, more difficult and expensive. On the other hand, the big blockers wanted protocol rules that could be changed more easily and faster in order to focus on dismantling short-term obstacles or addressing arising opportunities with more of a startup mentality. Larger blocks would allow for higher scalability and faster transactions. However, increasing the block size does not come without trade-offs. First, larger blocks lead to larger blockchains. Currently, the entire blockchain, all transactions ever recorded on Bitcoin's open source ledger, is approximately 400 gigabytes in size. This makes it feasible for nearly anyone to download the entire blockchain and run a full node from their home computer, or even a specially built simple computer that costs approximately $100. If the blockchain is larger, it would become more expensive and harder for individuals to run a node, and could lead to less decentralization, as only corporations or those with more expensive equipment could build and run nodes. Larger blocks also mean there could be non-full blocks that would lead to low transaction fees. While this certainly helps scalability, it could conversely lower the incentives for miners due to lower transaction fees, particularly as the block subsidy, the other portion of the rewards miners receive, continues to get cut in half every 4 years. If miners discontinue operation, this decreases the security of Bitcoin's network. In summary, the block size war demonstrates the blockchain trilemma inherent to Bitcoin's network. Larger blocks could increase scale or throughput, but at the potential loss of decentralization and security. The other important point about this history is that the changes proposed would and did result in a hard fork, meaning the change of the code would not be backwards compatible, and all nodes would have to upgrade in order to avoid a split in the network. The various hard forks that have come about because of or in relation to the block size war have either failed completely, such as Bitcoin XT and Bitcoin Classic, or have struggled to gain any kind of market dominance, such as Bitcoin Cash and Bitcoin SV. Again, here's a chart in the video of Bitcoin's dominance versus the other copies or other proof of work coins. Bitcoin continues to dominate the market cap of all competing currency tokens as seen in that graph. Bitcoin Cash case study. One of the most notable hard forks that came out of the block size war was Bitcoin Cash. Advocates of this hard fork believe Bitcoin should first and foremost be a literal peer-to-peer electronic cash system, or a system that can handle large amounts of transactions. In other words, Bitcoin Cash advocates believe Bitcoin should first focus on becoming a reliable medium of exchange rather than a store of value. We emphasize there's nothing inherently wrong with this approach, but it once again demonstrates the trade-offs made for more scalability. There is also nothing stopping developers and the marketplace from choosing Bitcoin Cash for faster or cheaper payments at the cost of security and decentralization. However, we can see that in terms of overall value, with Bitcoin's market cap 100 times that of Bitcoin Cash, investors have continued to choose Bitcoin as the preferred monetary network and therefore appear to value a security, as they prefer Bitcoin is 100 times that of Bitcoin Cash, and investors have continued to choose Bitcoin as the preferred monetary network and therefore appear to value a secure and sound store of value over faster or cheaper payments. Bitcoin as a superior monetary good is more valuable than a better payment network. This leads us to another point as to why we believe Bitcoin should be considered primarily as a monetary good rather than a payment network. The fact that the market has shown a preference towards Bitcoin, which is slower as a payment system compared to other digital assets and blockchains, signals the market currently values a highly secure and decentralized store of value rather than another payment network. As we previously noted, Bitcoin's revolutionary invention was solving the problem of digital scarcity and creating a digital store of value, not making an incremental improvement to a payment system. Ethereum case study. It is beyond the scope of this paper to examine the Ethereum network and the Ether token in its entirety. However, it is instructive to observe some of the similarities and differences between Bitcoin and Ether, which is the second largest digital asset by market capitalization. From its inception, and as an idea published as a white paper, Bitcoin set out to solve the problem of purely peer-to-peer, a truly peer-to-peer version of electronic cash. Its network was designed to be decentralized and secure so that value could be sent without having to trust an intermediary. This was combined with a pre-programmed monetary schedule and credibly enforced supply cap of 21 million, giving Bitcoin the ability to become a monetary good and store of value. Ethereum has also stated as a white paper. Ethereum also started as a white paper originally published in 2013 by Vitalik Buterin. In summary, Ethereum set out to take the blockchain technology pioneered by Bitcoin and extend it to include more capabilities, most notably the ability to do more complex transactions. From the Ethereum white paper, quote, "What Ethereum intends to provide is a blockchain with a built-in, fully fledged, Turing-complete programming language that can be used to create contracts that can be used to encode arbitrary state transition functions," end quote. This allows the Ethereum blockchain network to host and run smart contracts that can be used to program all kinds of applications. It is for this reason some like to refer to the Ethereum network as a distributed world computer. The network also allows different tokens to be issued on Ethereum, the Ethereum blockchain. This network acts as a kind of platform that others can use to build multiple applications on top of, including decentralized finance applications, games, social media tools, etc. While Ethereum may be viewed by some as a superior or more advanced network compared to Bitcoin, the additional capabilities and flexibility come at a cost, most notably a more complex network that increases the chance for software bugs as well as less decentralization and more potential decline in security. Below is a summary of some of the differences and trade-offs between Bitcoin and Ethereum networks. The primary purpose for Bitcoin is decentralized, secure monetary network. For Ethereum, it's a distributed world computer. The speed of improvement in implementation for the Bitcoin network is very slow and deliberate, and for Ethereum, it's fast and responsive to user demand. Programmable or smart contracts? No for Bitcoin on its first layer, but yes on the Ethereum network. Ability to host multiple tokens? No, only Bitcoin. Yes for Ethereum. Monetary policy? Fixed for Bitcoin, pre-programmed, is never changed. For Ethereum, it has changed and is expected to change again. Auditability. How many tokens exist? Yes, very easy to audit at any time. Ethereum can be audited, but may be more difficult. Level of centralization. Very decentralized for Bitcoin, and for Ethereum, it's much more centralized. Cost of a node for Bitcoin, cheap, relatively, about $100 or so. Very expensive for the Ethereum network to run a node. And for the Bitcoin network, the consensus mechanism is proof of work. And Ethereum is currently proof of work, but plans are underway to move to proof of stake currently. How Bitcoin may position itself against the rest of the digital asset ecosystem. As we previously noted, the open source nature of Bitcoin creates the ability for individuals to easily copy, alter, and build off the original Bitcoin base code for their own tokens and projects. This has allowed for the creation of a massive amount, literally thousands of alternative coins or altcoins, leading to confusion for newcomers to the space, at times causing some to misstate that Bitcoin is not scarce because there are hundreds of coins, thousands now, I believe over 20,000 at current reading. However, from our discussion thus far, we have proposed: Number one, the Bitcoin network is not compatible with other blockchain networks, and Bitcoin tokens are not fungible with other tokens. Therefore, Bitcoin tokens are scarce, while digital tokens, broadly speaking, are not scarce. Number two, the primary value driver of Bitcoin tokens is the scarcity and credibly enforced supply cap. Number three, Bitcoin is best understood as monetary good. And number four, Bitcoin is likely to be the primary monetary good, and another digital asset is not likely to supersede Bitcoin in this role. In addition, we have seen that Bitcoin is currently the most secure and decentralized network, but at the base or native network layer, it is not the most scalable. Bitcoin's network also does not allow for additional functionality or programmability, as we have seen in our comparison to Ethereum. Because of these inherent trade-offs, we have seen a boom in the digital asset ecosystem, with hundreds, if not thousands, of different projects all looking to achieve some different level of usability to fulfill a market need. Investors, of course, naturally wonder what the eventual end state of this innovation looks like. Although no one knows exactly what this may become, we think it's instructive to examine two dominant narratives that have grown popular for envisioning the future digital asset ecosystem. Particularly, we are interested in how Bitcoin may assert itself in each of these scenarios. Number one, a multi-chain world. The current construction of various tokens has led to a relatively siloed digital asset universe, with developers opting to work within a particular ecosystem. For instance, Bitcoin's construction is fundamentally different than that of Ethereum. The result is that Ethereum and its entire ecosystem of tokens and NFTs are incompatible with native Bitcoin and unable to interact in an easy and trustless manner. To date, trusted third parties have been a critical requirement for swapping assets that live in different silos. Bridges are being constructed to connect various blockchain ecosystems to one another, an important theme we have observed and expect will continue in the coming months and years ahead. Interoperability will be a key development for the success of the digital assets ecosystem. If we are to assume that multiple chains will win due to various base layer trade-offs, use cases, and value propositions. And again, here's a chart of the Bitcoin ecosystem and the Ethereum ecosystem and the bridges and apps and development going on in the different platforms. In a world of multiple winning chains, it still appears that Bitcoin is likely the best equipped to fulfill the role of the ecosystem's non-sovereign monetary good, with relatively less competition than other digital assets attempting to fulfill alternative use cases. The explicit emphasis on security and maximum decentralization reinforces its rule set and enforces all users' rights equally. Furthermore, as a result of its scarcity and enforced supply limit, Bitcoin is the closest as a digital protocol could be to enforcing absolute scarcity. In other words, any project or other blockchain network that requires its users to believe they are transacting with a token that has real monetary value likely needs to be directly or indirectly connected to Bitcoin as the ultimate monetary good. For example, people use tokens at an arcade for ease of use and utility and attribute value to them because they know they represent a certain dollar amount, or can be traded for other goods and prizes. However, outside the native arcade environment, the tokens have little to no value. This world leaves non-Bitcoin tokens battling to prove other viable use cases for their technology. They're aiming to find the right trade-off or some particular level of base layer scaling and encountering vast competition for development and functionality enhancements. This is not an indictment of those building on or investing in non-Bitcoin chains, but merely an observation that Bitcoin's clear advantage as a store of value asset reduces its risk even in a world that contains an ecosystem of many vibrant digital assets. Assuming this outcome, Bitcoin is still a clear beneficiary of flows into the overall digital asset space, given that it is viewed as the ultimate monetary digital asset, making it arguably the greatest risk-adjusted and easiest investment to understand and allocate towards across all of the digital asset landscape. Number 2, a winner-take-all or most world. Blockchains are undoubtedly an important technological creation. The ability to take an otherwise centralized database of information and remove a trusted third party was a radical, not incremental innovation. However, a centralized blockchain is relatively indistinguishable from a database and reduces the important qualities offered by a decentralized blockchain, including immutability, seizure resistance, censorship resistance, and trustless design. Thus, we can envision a spectrum of decentralization that has taken place with tokens. This varies from as decentralized as possible, Bitcoin, to tokens whose protocols are decentralized in name only and give exorbitant power to the developers or certain community members. Therefore, there is a possible scenario where users and investors will prefer different tokens based on the trade-off of less decentralization for more features. This is similar to the multi-chain world described above. However, there is another scenario that could arise due to the ability for applications and scaling solutions to be built on top of the base layer, or layer 1 blockchains. If applications can be built on top of an existing blockchain network rather than be forced to start a new network, users would arguably want to build on top of the strongest, most secure networks. Therefore, we could see a world in which one or very few of these blockchains accrues the majority of the value in the digital asset ecosystem and is chosen as the premier blockchain network. Given that Bitcoin is arguably the most decentralized and immutable blockchain in existence, it appears as a prime candidate to be one of, or perhaps the sole winner, if this situation were ever to play out. The Bitcoin Lightning Network. One interesting Layer 2 application we are already witnessing being built on top of the core Bitcoin network is the Lightning Network. This is a decentralized network that is built using smart contract functionality and allows off-chain transactions between persons, but with the ability to make a final settlement transaction on the base layer Bitcoin network. A simple analogy of this would be participants opening a private tab between each other, transacting back and forth with greater speed and very low transaction fees. This increases Bitcoin scalability, but with the option to settle at any time on the base layer, it still benefits from Bitcoin's security. The Internet and its base layer, TCP/IP, provides a perfect example of this. The Internet Protocol Suite, known as TCP/IP, is an open source base layer for communication to flow through and subsequently applications and content to be built on top of. The TCP/IP protocol is not owned by anyone and as it is open source, Internet of Information does not allow ownership of the base layer. Rather, ownership is only possible for the applications and technology constructed on top of it. In contrast, ownership of the base layer is possible in the digital asset world. Like TCP/IP, applications can also be constructed using the base layer, and then these technological upgrades enhance the value captured of the base layer. The innovations from Amazon, Facebook, Google, Netflix, and others made the Internet's base layer far more valuable and important. Similarly, the innovation taking place in and around particular digital asset protocols make the respective base layer ownership breadth increase and enhance its use cases and usability. What is interesting about this architecture is that an investor can own part of the base layer of this new technology and can be relatively agnostic about what specific applications are built on top of it. It would be akin to being able to own the base layer of the Internet and getting exposure to all the innovation on top of it. Example, Google, Amazon, etc., without having to try to pick the specific winners and losers. And again, there's a picture here to the right in the video that shows the Internet of Information today versus the Internet of Value today, and how the protocol layers of the current Internet are built and the application layers versus Bitcoin, the currency, and Bitcoin, the network, and the application layers on top of that, and being able to own where you can own the different layers in the current Internet and then the future Internet on the Internet of Value today with Bitcoin, where it shows you can own the base layer where you couldn't in today's Internet. Bitcoin is aiming to satisfy a clear market need. Of course, we do not know what the digital asset system will look like as it continues to mature, or whether we will see a multi-chain world of different tokens with varying degrees of centralization, or if we will see a winner-take-all approach where more applications are built on the most secure and decentralized chain. However, it appears at this point that Bitcoin has found a role in the digital asset ecosystem as a scarce store value asset at the very least. The ability for all of the other digital assets to fulfill some other necessary use case remains to be seen, in our opinion. The same cannot be said for Bitcoin. This creates far different risk-return investment profiles between Bitcoin and all other digital assets, and ultimately should impact how allocators consider incorporating each into their investment portfolio. digital assets' place in a portfolio. Investors working through their understanding of the digital asset ecosystem and creating a framework for considering investment in the space are likely to benefit from segmenting Bitcoin and all other digital asset investments as separate decisions. This simplifies the portfolio construction process and allows for two simultaneous yet separate decisions to be made by allocators. The importance of holding exposure to the scarcest monetary asset in the emerging digital asset category, Bitcoin, while also considering the potential for exposure to the innovation and experimentation ongoing with the ecosystem outside of Bitcoin. In order to understand the proper place of Bitcoin and non-Bitcoin tokens in a traditional investment portfolio, investors must first derive the key risk and return drivers of their respective investment theses. This makes it possible to delineate the two and draw a conclusion upon the potential role each could play within an otherwise traditional portfolio. Bitcoin's risks, potential sources of return, and a role in a portfolio. The first mover advantage led to a lack of true competition for Bitcoin's primary use case as a monetary asset and a store of value, and creates a drastically different return profile for Bitcoin investors. Many of the risks that could have been used to create a use case for the demise of Bitcoin are now gone, and each day the network grows stronger with more users, miners, and infrastructure being built. Almost every risk that Bitcoin still holds today can also be seen amongst every other digital asset, with nation-state attacks and protocol bugs being two of the most notable network risks. Protocol bugs. The potential for a vulnerability in any code is always a present threat. This problem can be mitigated by keeping the particular software simple and engaging in thorough review and scrutiny of the code. In Bitcoin's case, it is arguably the least likely protocol to encounter a major bug at this stage in its life, given it has existed longer than any other project, holds an intentionally simplistic code, and now has $1 trillion bounty for anyone capable of exploiting it. Nation-state attacks. Another valid risk to the Bitcoin thesis is the potential for large countries to oppose the growth of the digital asset ecosystem. The geopolitical landscape to date has made proper regulation appear far more likely than outlawing these assets. In any case, Bitcoin is best positioned to defend itself against coordinated attacks due to its prioritization of decentralization. The risks Bitcoin faces today appear lower in comparison with all the other digital assets, given the lack of code and complexity and emphasis on decentralization. Little to no true competition for its primary use case, and 13 years of operating as a store of value token help to harden the case that Bitcoin will continue to exist as the bedrock of the digital asset ecosystem. In other words, it is not that we think an allocation to Bitcoin does not come without risk, but that we think some investors are overestimating the downside risk of Bitcoin when compared to other digital assets. We also think some investors may be doing the same with the return side of the equation, but in the opposite direction, as they may be underestimating the potential returns to Bitcoin compared to other digital assets. There is some merit to this idea, as Bitcoin, with a market cap of around $100 trillion, may have a harder time appreciating by a factor of 100 compared to its earlier history when it did go up by a factor of 100 more than once, but from a much smaller market capitalization base. However, these rewards were accompanied by a lot more risk at the time. As described above, Bitcoin's level of risk has been dramatically reduced from its very early days. Furthermore, we think the return potential for Bitcoin is still very sizable. Bitcoin's return profile is driven by two strong tailwinds: the growth of the digital asset ecosystem and the potential instability of traditional macroeconomic conditions. These return tailwinds are likely to be captured in an easier way with less risk than via the majority of other digital assets. Growth of the digital asset ecosystem. As money flows through the entire asset class, the store of value standard gains further legitimacy and importance. Every project, token, or piece of infrastructure being built and funded is expanding the use case and value associated with having a neutral, scarce digital reserve asset. While other tokens benefit from money that flows indirectly towards the space, Bitcoin is the easiest way to benefit from this growth. As discussed earlier, Bitcoin's lack of competition for being recognized as the preeminent store of value asset means there's little threat to its current stronghold on being the ecosystem's money. Much of the growth associated with the build-out of all digital assets is good for Bitcoin. Potential instability of traditional macro conditions. The increasing use of monetary and fiscal policy as a way to provide support for ongoing economic growth may give rise to concerns about the overall stability of the financial system and the ability for the economy to stand on its own. The buildup of these policies has led to never-before-seen global sovereign debt levels. Leverage has historically driven financial systems towards fragility. One such potential outcome as a result of the current situation is the path of financial repression, negative real interest rates. These types of macro environments have historically tended to benefit scarce assets whose supply cannot be altered. For example, gold's outperformance in the most recent episode of high inflation and therefore negative real interest rates in the late 1970s. In the digital asset world, Bitcoin's rule set, historical precedents, and decentralization have created the greatest level of scarcity of any digital asset protocol. This makes a compelling case as the greatest available hedge for some of the potential headwinds facing the legacy financial system. Given the ability to hedge potential outcomes associated with the traditional assets and capture overall ecosystem growth, Bitcoin becomes a simple and efficient way to gain exposure to the digital asset system. Non-Bitcoin risk and return drivers. Many investors often cite the potential for extremely advantageous returns as a reason for overweighting alternative or non-Bitcoin digital assets, and in some cases, omitting Bitcoin entirely from their portfolio. While this potential return profile may exist for certain digital assets, it's important to consider that these projects also often come with greater overall risk and a meaningful chance of the token becoming worthless if it fails to live up to expectations. The risk with non-Bitcoin tokens certainly ranges on a case-by-case basis and tends to become more extreme in longer tail, more speculative tokens. However, many of these risks are still shared amongst the majority of these projects. A few key risks are noted below. Exhibiting adequate decentralization. Bitcoin's proof of work algorithm, governance structure, and fair launch created the grounds for a decentralized project with minimal trust required. Other tokens have alternative consensus mechanisms, governance structures, and token launches, which often reduce their level of decentralization. Since it is one of the key value propositions being promised by the majority of these protocols, investors should consider how decentralized their particular project actually is. A lack of adequate decentralization makes a particular protocol more susceptible to regulatory oversight and impairs users' rights. The threat of competition. Differentiation becomes difficult with open source code when one platform is able to copy and build upon the shortcomings of another. Historically, we have witnessed many failed projects, and the turnover amongst the most valuable 10 or 20 coins has been extreme. Protocols must build a large enough network effect around their given use case in hopes that they can defend themselves against competitors, since almost every non-Bitcoin network is attempting to add some level of scalability or functionality to the base layer to prove their worth. The return drivers of all non-Bitcoin digital assets are also much different, given that protocols are forced to make certain trade-offs to enhance speed, functionality, and other characteristics to warrant a use case. Encompassed within all non-Bitcoin digital assets is the most important driver of returns: attracting developers and creating network effects. Projects which have shown the ability to be successful and create something promising have done so by bringing the proper talent on board and retaining their user base. Ethereum and Solana provide a great example of what is possible for a protocol that can attract a large amount of developers, build a usable platform, and gain a loyal network of users. When done right, there's clearly a lot of value that can be created for investors. And again, you can see the top 10 digital assets, a chart here by market cap from 2017 up to 2022 to see how that changes over time and the stability or lack thereof of the certain coins. Given the increased amount of competition and potential paths of failure for many of these projects, allocating to non-Bitcoin tokens is often done with a venture capital-like mindset. Instead of picking one particular project, investment allocators typically take small positions across many individual names. This typically results in seeking out an actively managed solution to deal with the increase in overall complexity. Again, showing a stark contrast to a simple Bitcoin-only approach to this digital asset space. In conclusion, traditional investors typically apply a technology investing framework to Bitcoin, leading to the conclusion Bitcoin as a first mover technology will easily be supplanted by a superior one or have lower returns. However, as we have argued here, Bitcoin's first technological breakthrough was not as a superior payment technology, but as a superior form of money. As a monetary good, Bitcoin is unique. Therefore, not only do we believe investors should consider Bitcoin first in order to understand digital assets, but that Bitcoin should be considered first and separate from all other digital assets that have come after it.